if you have a team that can solve these types of problems and you can keep some of it from subbing it out after you take the property over, and you can do it efficiently and manage the project, you have a very good shot of making a lot of money in multifamily investing. Hello, everybody. This is Jake Stenziano, host of Wheelbarrow Profits Podcast, here with my co-host, the multifamily mentor, the coach, the chef, the father of 6, the best-selling author, the G-Daddy, Gino Barbaro. Gino, how's it going?
Mr. Stenziano, I am doing good, Broseph. How you doing?
Always making it happen, big man. Today's guest is Wally Conway. Wally is a high-level building inspector who's been featured on HGTV, DIY, and hosts his own weekly radio show in Jacksonville, Florida. So without further ado, Wally, let's get this thing kicked off. How you doing today?
I am doing outstanding and real happy to be with you guys.
Hey, why don't you just give us a little insight into your opinion on what is the best way to systematize the inspection process when buying an apartment building? Because I think there's so much fear around it, especially for investors on their first few deals. Is there a way to systematize the process so that they can partner with good folks and sort of help relieve some of that fear and anxiety with the process?
Well, it's totally about systems. And here's the most important thing, is to be sure you've had a conversation with your lender, with your broker, and in your own mind, so you know what you need to have clarity to make great decisions. So at the level that you guys are performing, having done this dozens and dozens and dozens of times, you may need less information than a person who's doing it for the first time. So it's critical that you've got everything you need for the lender, everything you need for your own decision process early on, and then you've got everything you need for the upgrades, kind of that punch list almost, so you have good expectation.
Why don't you tell us a little about your background? Jake jumps in right away. I want to get to know you a little bit. I want to get to know how you got started.
That's my problem, Gino. I get to the point. That's a blessing and a curse, man.
Well, we are kindred souls of sorts. I grew up in Camden, New Jersey, so do not mess with me. I'll take you. But so I finished high school there. I went off to the Naval Academy. I graduated from there. I was a Navy pilot. That's how I ended up in Jacksonville, Florida, as a Navy pilot. Retired in '94. Prior to retiring, while living on aircraft carriers is a fun thing to do, and it's pretty cool, every now and then you'd like to sleep in a warm bed that's got a little space for another person. So I got looking for houses and discovered that houses cost more money than I had. And this was in the early '80s. And gosh, houses in Florida at that time were well over $40,000.
Woo!
Yeah, man. So I got hanging around construction sites trying to understand why things were so expensive. And I came to the reality that the guys building houses and apartment buildings weren't especially more clever than I, and perhaps I could do it. So I thought, gosh, I think I'll become a contractor. So what I did, I drew a house on a napkin and I bought a piece of dirt. I still didn't know anything about construction, and I didn't have any money. So I went to Savings and Loan and said, hey, I've got dirt, I've got a dream, can you give me money? And they said, well, you need plans. You can't bring us a napkin. So I went to the Yellow Pages, and some of you will remember the Yellow Pages, some not so much. And I looked up house design. And I went to that person, and I gave them a check, and they gave me house plans, and I went back to the bank. So now I had dirt and plans and no money. They gave me money. Now I had house plans, dirt, and money, and I still didn't know what to do. So I went back to the Yellow Pages. The first thing on that set of plans was a footer. So I looked up footer in Yellow Pages, called the guy, I gave him a check, he gave me a footer, and I turned the page. The next thing on the house plans was a stem wall. I looked up block walls in the Yellow Pages. The guy came over, I gave him a check, he gave me a block wall. I did that about 30 times. I ended up with a house, and soon after then went and sat for the state contractor's exam. So when I retired, I thought, gosh, I've never been on a job interview, never had a real job. No one would hire me in their right mind. Perhaps I should start a company. And that's where we got involved in the inspection business. And we've now, we have Monument Commercial Building Inspections, a commercial company. We have a residential company. We have a chimney service company. And all that started from wanting to do something more and something different, and just jumping in and doing it.
So before I ask my next question, I want all the listeners out there to go back in the 80s. It's been a lifelong problem. where their house is worth 40,000 back in 1980, or it's worth 300,000 now. We don't have the down payment. So don't make the excuse today that things are different than they were 30 years ago. They're not. It's the same exact thing. Houses were always expensive. People always never had the money. Even though my parents were paying $150 a month for their mortgage back in 1973, that was a lot of money back then. People don't realize that. So stop making the excuses that houses cost too much and everything's changed today. It really hasn't changed. The only thing that's changed is we've become less of producers and we've become more consumers. So when you consume more, you have less for that down payment. And you can't be like Wally, buying dirt and taking that risk if you have tons of student debt. Am I right, Jake?
You're absolutely right. And the interesting thing is, I mean, we were going through this article the other day. A lot of the folks that are buying homes now, they don't really take into consideration the maintenance and upkeep that has to go with it, because
Great point.
they're probably not building something like Wally. So when that roof goes or that gutter's down, they don't know what to do with it. So that's why I think we see such a demand for rentals these days.
I love that point.
The passage of time and things not being really that much different. The only thing that's changed over time is a decimal point or two. And it's the same for the investor making the transition from single family to multifamily. All that's changes is a couple of decimal points, but process-wise, it's really very, very similar.
Mm-hmm. I'm going to get into the, we call it the 3-step due diligence process. We call it financial first, then the physical, which is what we're going to totally discuss with you, then the legal. I just want everyone out there to know, I've had investors come up with me. We had a meetup last week in Jacksonville. Investor says, how can I skirt or how can I not pay for the physical? I say, you're either going to pay now or you're going to pay a lot more later. So you have to pay for the inspection part. So when we go into the physical due diligence, let's take a holistic view. Let's break down the whole aspect of the physical aspect. Where do we start?
You really start with a structure in a sense. You want to be sure that the bones are solid. Mm-hmm. That's pretty easy for a professional to do. You can even get an idea yourself. If you step back from the property and get that big look, if it looks like it's going cattywampus or you see giant cracks, you may have a structural issue, maybe not. But if the bones are good, virtually everything else is simple as long as the math makes sense.
Okay, and then from the bones, do you recommend everyone going to every unit? How do you perform on a multifamily?
That's going to depend on how many units are there and the level of comfort for the individual. Mm-hmm. So 8 units and below will virtually always hit every unit. Mm-hmm. Once we get above that, and especially if there's multiple buildings, generally what people choose is very few people choose every unit. It just gets expensive and time consuming and frankly redundant to review the data. Mm-hmm. 1 per building is very reasonable. And that next level of reasonability would be 1 per type per building. So if you've got a building that's got, let's just say 12 units in it, it's got you take 1 on the first floor, 1 on the second floor, 1 it's a bedroom, 1 bedroom, 1 it's a 2-bedroom. You just try to get that, we call it a representative sampling, mm-hmm. and judge your reasonable expenses based on what you see from that sampling.
See, Jake and I, what we like to do, we'll spend more money. We like to go into every unit because we buy mom and pops. We're not buying these newer assets. So we know a lot of these units have maybe some mold. They have some appliances that are missing, some flooring. So we want more information, and we don't mind paying on the front end because we know when we go to retrade that some of these units that are down, we can get money for it. So everyone out there, you're making an investment on the front end. You're going to find stuff on a lot of these mom and pops that the owners haven't quote unquote disclosed. So do you see that come up a lot, Wally?
Yeah, and we have a one-liner we often use, and that is this. In the history of real estate, there has never been an unexpected surprise that was less than aggressive due diligence.
Wow, break that down for you. That was too fast.
It's too early, Wally. You got to slow down a little bit.
I've been up since 4:30. Now I get up, I work out. I got lots of things going on. But
chunk this down for me here.
I'll chunk it down. It chunks down this way. There are no good surprises in real estate.
Check.
You won't buy 100 units. Then after closing, you go count them, and there's 150. So there are only negative surprises.
Yes.
Gotcha.
In the history of real estate, no matter the expense of due diligence, let's say the due diligence for the units was $5,000. In the history of real estate, there has never been an unexpected surprise that was smaller in dollar value than aggressive due diligence.
Got it.
We got it.
Man, I didn't have enough coffee this morning. We got to focus, Gino. We're at the spot right now.
Another sip. You'll be all right.
Whew. Yeah, I got that now.
Don't shoot out on the front end or you're going to get screwed.
Yes. I've made a lot of mistakes on due diligence. A lot of them came from legal due diligence, not so much physical. But what big mistakes do you normally see? Let's go with beginning investors. I'm an investor. I'm buying 12 units. What mistakes or what things would you tell him to focus on, him or her to focus on in the inspection process?
Well, to me, the physical due diligence is really a piece of the financial due diligence, because a deal that looks like it makes great sense doesn't make great sense if the upgrade costs or the deferred maintenance recovery is too high. So it's making sure, to your point, that you've got a good handle on what makes the deal make sense. And then if it turns out after due diligence, the math doesn't work, it's okay to not move forward on that deal. You know, I live my life by one-liners, you can tell that. Bad news doesn't get better with time. So if we do great due diligence, with the financial, the legal, and the physical, if the physical due diligence doesn't fit into the financial, you've saved a boatload of money by spending a little bit of money.
So once the finances work out, let's go through the whole physical process. What do you see investors making mistakes on when they're inspecting or they're having an inspector inspect the building?
The biggest thing I truly see is they're not communicating between the investor and the inspector ahead of time. So I may have in my brain, what's the appropriate level of diligence? What's the appropriate level of documentation for a specific property? Depending on the sophistication, the experience, and the expectation of the investor, as well as any lender-driven requirements, we may produce a flawless document that doesn't get it where it needs to be. As an example, if it requires a property condition analysis, that's a different formatting and a different protocol than what we might do in a more, I guess you'd say, traditional sense if it didn't require the PCA. If someone's expecting a PCA because it's lender-driven and the document doesn't match that format, it's not even reviewable. Likewise, especially on smaller properties, if the due diligence is in a PCA format, they're not comfortable reading it, they're not familiar with what to do with it, they can't make good decisions. So it's communicating so that expectation is met.
Jake, why don't you go through our due diligence of the 240 unit deal and let Wally listen to what we did on our deal. We've come a long way from a 25 unit property.
Yeah, so we have a team. We actually partner with our building inspector alongside our property management team.
Excellent.
And what we do is we send one of the guys who has years of experience as a contractor. We actually send him around the exterior of the property just to make the process more efficient. And to your point, looking for structural things and you know, checking anything that he may see from the exterior standpoint that's not where we want it.
Right.
While we have a certified HVAC contractor on staff who actually goes along with our inspector just to speed it up, because we did, like you just said, we did 243 units the other day. So he's helping him with the mechanicals as he's taking notes on each unit. And we're going through, and part of the reason we go through each unit is simply because we've gone into deals before and there's been units that have been totally gutted or something, and we wouldn't have caught that by, you know, just the goodwill of the seller. So it's created a fear within us where we don't want to have to drop 10 grand on a unit because we didn't catch it on the front end. And to your point, the inspection is going to be much less than that. So we take that bet every day of the week.
And
yeah, I like that. That's a wonderful position. What we typically do at Monument is we offer them a small, medium, and large. The ideal is to be in every unit. Our experience has been most people don't go that route, though they rightly should. I love your position of having your maintenance person there. I also like to have the facility maintenance person there if they're available, as well as any contractor. From a staffing position, we have 10 people on staff. If the situation warrants it, we can be out of 240 units in the morning. And what we always want to be is in a position where the building manager is not holding us up and we're not holding up the building manager or the tenant. So it's a back and forth to get that scaled, to get in and get out as efficiently as possible.
Yeah, and so to your point, we'll take the maintenance manager with us. He's usually keying us in, and then on day 2 or day 3, depending, because we are walking each unit, we will then do crawl spaces and attics and any roofs. So, and then what we also do is Uncle Sean, who's on the team, does a lot of our video work. He'll take a drone overhead and check out the roofs and things like that. So if anything is flagged, then we'll put extra presence on that roof. So that's typically our process. But also then we're taking the snake and we're going in the lines and really taking a look at the drain lines to make sure that we're not running into anything crazy. Because for the first time ever, we saw a deal that had clay drain lines on it. I mean, these things were thick, though. I mean, they were thick and whatnot. But as you know, over time, trees and roots will try to get into them. But yeah, that's basically our process on the front end to go through to check as many boxes as possible.
And how is that document compiled in the process you're presenting? So
that's the building inspector. So he will take feedback. He's sort of the catcher, if you will. He'll take feedback from our person that's on the outside, and then if he flags anything, not that he's not looking as well, but it's for, if anything is flagged, I think more eyes on it the better. So he'll compile that into his document. Any of the drone footage, anything on the mechanicals, and then we'll get it on an SD card for the drain lines as we're snaking.
Yeah, you mentioned the drones and technology. That's really critical.
Yeah,
the technology has gotten so, frankly, inexpensive and so capable. So we're flying the drones, doing the sewer scope, and also the infrared. The infrared can get all types of insight into what's going on moisture-wise that you might not otherwise know with incipient leaks and things of that sort. So that's a real plus to be sure that you're bringing the technology to bear.
So, yeah, we just try to get our team on site because it's the same thing. We take a vertically integrated approach to our management end of it. So why not take it to the buy side? We want to be incorporated because I think there's no time in the history of business where someone that has, well, it shouldn't be at least, when someone has equity at stake and true ownership in something, we think we're going to do a better job than if we're just totally subbing out. So we like to be always partnered as much as we can with folks like yourself.
Yeah, agreed. It's getting all those perspectives too, because the existing building manager will have a history and a knowledge that's not discoverable otherwise. So anything we can do to get that building manager on our side, we're always looking for that too. And
absolutely.
The building manager, I wouldn't say they convey with the building, though often they have a desire to remain with the building. And my discovery is befriending that existing staff can go a long way.
Building rapport on the front end there is so huge, because the problem with multifamily, and I think, Gino, I heard this from Ken McElroy, is that when you're a good property manager, you're in trouble because then they're going to sell your building because it's worth more. And if you're not doing good, they're going to fire you. So either way, you're screwed.
I like that. And the funny thing is, everyone's listening to this and going, I can't do a 240 unit building. We started with a 25-unit building. The best thing we did, we partnered with a building inspector. He charged us per unit. He was very, very reasonable at the price, but we told him this is not our first deal. We're going to grow with you, and we want to work with you. So on the 25-unit, we didn't have all these systems, all these processes in place. He did a lot of the heavy lifting, and we learned. And then when we got the contractor, so it's like, people want to start out with a 100-unit property. Maybe it's better to start out with something smaller so you can handle this physical inspection, the financial due diligence. Because if you're thinking 100 units, but your mind can't wrap yourself around it, pull it back. Do a 10 or 15 unit property so you can handle all the work and not make that big mistake. I mean, another one-liner, no deal is better than a bad deal. And you'll find out if it's a bad deal during physical inspection, because if it's a bad deal and you have something and you're forcing the deal, that's the worst thing to do. You need to create a budget from this physical inspection. And if you have 100 units, it might be a little bit more difficult, a little bit more daunting. But if you have that 10 or 15 to 20 units on the first one, you can pivot, you can make mistakes. It won't put you under. It's a lot more doable. So, what do
you have the processes though as well. So you're showing the folks out here. Here's Wally. Wally, you can partner directly with Wally if you're worried. But then on the other hand, Gino, you have a list of documents that take people through each phase of the due diligence process. So I think shortening the learning curve, getting someone with Gino, who's going to show the documents that you have in order to get through the process, and then partnering with someone like Wally to and that's what I was trying to drive at in the beginning, was it's about your systems when you're going through this stuff. If you have proper systems in place, you're going to pull it through and you're going to be successful.
I think it's important, especially for the newer investor, or if it's a newer property type to them, to participate in that inspection process as much as they're physically able. You'll really sharpen your own eye, and you'll sharpen your decision process with a lot of walking and talking and seeing and smelling and touching. And when you're doing that initial screen yourself to decide which properties you even want to write a contract or an offer on, you'll make better initial decisions by having a little bit of that experience of walking and talking with your inspectors.
That's an amazing point, Jake, honestly, because if you are syndicating, you're raising money and you're doing a deal, if there's a mistake and you're on the property, you can always say to your investors, hey, you know what? I was there. I missed it. It's a little more palpable than if you're 300,000 miles away and you're like, I didn't have a chance, didn't want to waste my time going there. You can at least say, I was there. I was doing the due diligence. We all make mistakes. But if you're aloof and you're not even there, that's not good. I love that point. Be on the spot. Wally, what do you typically normally see, especially down here in Jacksonville, as problems that come up during the physical due diligence, whether it's mold or whether it's age? What do you typically see?
Well, back to the one-liners. Everything that goes wrong in a building will somehow be related to the mismanagement of moisture. The roof leaked, something flooded, something backed up, the HVAC condensate line, there's too much humidity because things aren't sized right. It's always moisture. And when we teach people, both internal to our own staff and investors, home buyers, whoever they happen to be, whenever something catches your eye, you see a sign or a symptom of concern, the first question you want to ask yourself is, I wonder what the source of the moisture was. And virtually always, that will lead you to what's causal. Because whether it's 1 unit or 25 units or 300 units, if we're spending money to treat symptom and we're not spending money to find out what's causal and treat the cause, we're going to spend that same money again and again and again and again.
Mm-hmm.
Very critical point.
I like that.
I got one for you, Gino, and I learned this from an inspector a while ago. It's a Wally one-liner. It always comes back to water. It's always, that is your biggest enemy, is it not?
Yeah. Something corroded, something stinks, something, no matter what it is, somehow it was a mismanagement of moisture.
Wow. So maybe you can answer this, maybe you can't. What in the physical inspection would make you walk away from a deal?
Nothing in a physical sense, because in my mind, it always comes back to the economics. Mm-hmm. And very frankly, and knowing you do a lot of mom and pops, often it's the imperfections in the property that make that property attainable and profitable. Mm-hmm. So one guy's nightmare is the other guy's opportunity if you understand how to get it priced right, how to get it repaired right, and all of a sudden, its imperfections are gold.
Mr. Stenziano, you want to jump in there?
Hey man, it's so spot on, because you make money in real estate by solving problems. Exactly. That's what I just heard from Wally. So
big problems, big profits.
Mm-hmm.
Yeah, and the more and I keep going back to this vertical integration, but if you have a team that can solve these types of problems, and you can keep some of it from subbing it out after you take the property over, and you can do it efficiently and manage the project, you have a very good shot of making a lot of money in multifamily investing, period.
Wally, what should customers expect from a good inspection report? What are they looking for in that report that's going to tell them about the property?
In my mind, it really comes down to clarity. Clarity, clarity, clarity. And clarity to me means this: a superb executive summary, so that you, the decision maker, the decision maker team, ideally in a page, has a go, no go. And then the detail behind that is to support that decision process and then to align any repairs or negotiations.
I like that. When I was looking for an inspector, how do you find a good inspector? It's still such a very fragmented industry. It's amazing to me. You go out and you can find a lender.
Especially commercial.
I mean, it is. I mean, tell our students, tell all the listeners out there, the Jake and Gino community, where do I start by finding? It's like buying a multifamily broker. They're all multifamily brokers. They're selling duplexes. They're not really multifamily brokers. And it's the same thing with inspectors. Yeah, they're inspectors. They're doing single family, maybe a condo. How do I find a good commercial inspector out there?
It's a challenge, and specifically in multifamily, it's a special challenge. Mm-hmm. So if we were buying high-rise office buildings and whatnot, in every city, there's one or more engineering firms that have the right staffing and the right mindset to do that due diligence. You're buying single-family houses, there's 1,000 man-in-a-van type companies that might be able to do that. The challenge, in my perception, is that with multifamily, it's much like 25 or 250 or 1,000 houses stuck together. The engineering mind usually doesn't do well in that location. And a man in a van is going to be in 250 units for the next 6 weeks. So the challenge is to find a company who's got sufficient staff and the right mindset to get in and get out at 250 units or 1,000 units, or whatever that number is, in a cost-efficient and time-efficient way, and the skill set to create a deliverable such that you can make a rapid and simple decision. You also don't want to wait 6 weeks for the deliverable, which is another challenge if the company doesn't have the scope and scale to do that.
And that's tough, Jake, right? Because when you're under the gun, you got 30 days to due diligence. You're already 14 days into it because you had to do the financials. You didn't get them all. And now you're doing the report. And it takes another week to do the report. And you're on day 26 and you've got 4 days to go. That's very difficult. Make sure you get them on the clock, correct? Correct, Wally?
It's important to set that expectation right up front. You know, we've been doing this 25 years. We've never missed a deliverable date. Part of that comes from setting that expectation. So if you've got 30 days, we're approaching that in one way. If you've got 5 days, we're approaching that in another way. So it's not difficult to meet deadlines when that expectation is set early. And to the other point of that, it's easier to cancel something than it is to schedule it at the last minute. So if you've got a 30, 60, 90-day window, you may not be ready to pull the trigger on the due diligence and say, ready, set, go. But you can have your people lined up. We can have that all scheduled to go, 30 or 60 days out. And if it turns out the deal goes away in that final 10 or 20 days, that's not a big deal. It's much easier to turn it off than it is to turn it on.
I love that.
Turn it off the morning of, we're going to tangle. But other than that, it's treating each other respectfully, setting it out there. That also lets us get a lot of our background due diligence out of the way. So as an example, we have a proprietary service called BuildFacts. We'll pull a permit history on everything. So we'll know who's been at the building, what they've done, the amount of work, the scope of work, which blends well in, especially in older properties or properties that have recently turned. Nobody knows what the heck's going on. And we also pull data we call the neighborhood environmental report, which is essentially a phase one without the expense. So sometimes properties that had a previous use. So if you had a previous military barracks, that before it was a military barracks, it was a toxic waste dump, you might want to know that.
How do you do that, Wally?
We can get out of the way rapidly and inexpensively. Every now and then, depending on the sophistication of the investor, they may layer those things in. So they may say, hey, I've got concerns on this particular property for my environmental. Run the neighborhood environmental report for me. We'll do that for a couple $100. And it moves you forward incrementally. Same with the permit histories and some of those other things.
Jake, you got that neighborhood environmental report?
Well, because a lot of times, if you've had a building that's been in a residential area for 30 years or something like that, you don't necessarily want to, spend a ton of money on these environmental reports. You do want to know that there wasn't a gas station there 40 years ago.
Well, here's how that plays out. The phase one environmental has two components. There's a data search and there's an on-site search. To blend those two things together and call it a phase one is expensive, and it's primarily expensive because of the crazy insurance requirements to label it as a phase one environmental service. What we actually do, not as a way to circumvent the phase one, if a lender for that particular property says it must have a phase one, it must have a phase one, that's all there is to it. The neighborhood environmental report does the exact same due diligence from the exact same sources as a phase one, except it's incredibly inexpensive, a couple $100. The on-site part is exactly the same as a phase one while we're doing either the PCA or the building inspection. So if you see oil tanks, you see things, they're always in the document. What we can't do is blend them together to meet the legal requirement as a phase one. But incrementally, we can get the same data. So if you do the neighborhood environmental report and you discover something that's a showstopper, you've stopped it early in the process. That's its purpose.
I like that. You said, over the last 25 years you've been doing this, which is a perfect segue. How has the industry changed over that time, whether it's technology, whether it's a stronger due diligence time period to, really go in, the savviness of the investors? What have you seen change over that time period?
I would say two things have changed, and ideally they stay balanced, but every now and then one gets ahead of the other. One is the technology, as we spoke about earlier, with the drains and the sewer scopes, infrared cameras, the technology that lets us do database searching that we could never have done before. So the technology has made us better and better and better and more efficient in delivering information. Simultaneously with that, the expectation of the individual investor and investment group continues to get higher and higher and higher and higher. Mm-hmm. There's this mindset that I should be buying 25 units or 250 units or 1,000 units, and I should experience no risk. We cannot get risk to zero. We can manage risk. We can manage risk aggressively and drive it down. But at the end of the day, whether it's a single unit or 1,000 units, there's an element of risk. That's also why there's a reward. The challenge is to do your due diligence in the three areas that you guys mentioned: your financial, your legal, and your physical, such as say, you know what? This risk is well worth it based on the reward in place, not zero.
I like that. Before we get into the short answer questions, what would be your best tip on an inspector, hiring an inspector, doing the inspection process?
I would begin with my broker and or lender to see who they may recommend, whether that's a long list or a short list. Seldom is it more than 1 to 3, and then have a conversation with that person. Share your fears, share your dreams, share your expectations, and have a conversation and say, I am comfortable with this person. They're going to meet my needs. They're going to give me what I need to make great decisions, or I'm not comfortable. You don't want to find out you're uncomfortable or incompatible, after the fact. That's not pleasant.
Mm-hmm.
All right, let's take a quick time out and hear from our sponsor. Gino, I know a lot of our listeners are wanting to take their multifamily investing business to the next level. I know that you've been hard at work helping Jake and Gino students do just that using our framework. Can you explain to the listeners how they can get our help?
Guys, we've been hard at work growing our community of like-minded investors, and the results of our members has been nothing short of incredible. We're looking to grow this amazing group. What we're looking for is those who want to follow our proprietary framework that we've created: buy right, manage right, and finance right. Leverage our connections, education, and mentorship as ways to take your business to the next level.
So if you're interested in finding out more about how you can become a part of our amazing community, apply to work with us at jakeandgino.com/apply. And we're back. All right, Wally, here's the question. This is me being a fan of the game. Okay, I want to talk vintage right now. I like 1980s and up. I find that once you get to the 80s, you get a lot of the amenities and just functionality in these apartments that you need. Is there a specific vintage that you feel comfortable with, and you say, you're going to be better off here, or is there maybe a vintage you stay away from? Any feedback there?
Well, it's really going to vary city to city, community to community, just based on existing stock. But one benchmark to make life a little bit simpler is 1978.
Yeah.
To avoid all of the issues in disclosure and documentation repair for lead paint. So things get way easier once we get that out of the mix.
Mm-hmm.
Is there something? What's the date for asbestos? Isn't that kind of tied into a similar date range, or am I off on that?
It's not as clear and specific.
Yeah.
78, the Lead Paint Reduction Procedures Act, Lead Paint Safety Act, whatever the heck it was.
Yeah.
Was super specific. It was a joint project between EPA and HUD, and there's great clarity in how it's managed. Asbestos is all over the board. If you're in Massachusetts, they're super hypersensitive. If you're in South Florida or Phoenix, where things are so much newer, it's not so much. So it's important to be comfortable in your own area and, frankly, your own risk tolerance.
Yeah. I mean, some of the things for us, we're really not into the gabled roofs and the flat roofs. I mean, we have some in the portfolio, but we tend to shy away from them. We don't really want the boiler chillers. And fortunately, we're at a point where in our portfolio, we're kind of just avoiding some of that stuff because we don't have, we haven't had great experience with it, and we may not want to operate it. So we're being a little more selective as well. Is there anything that's because again, it comes down to, dollars and cents.
Yep.
We were talking about it a minute ago. Is there anything where you're like, because I'm kind of maybe saying to my people, this is what we kind of avoid. Is there anything that you're suggesting, well, you could do it, we really don't love this stuff in terms from a physical standpoint?
That really takes my brain toward insurability.
Yeah.
That depending on the age of the property, doesn't have aluminum wire, doesn't have asbestos and some of these other things, while your acquisition cost or even your maintenance cost may be the same as a newer property, you can be in an insurance position that pushes that number right out of doable.
Yeah, it's interesting. On the personal success sides, you're mentioning you got up before 30. Is there a habit that you have that's led to your success that you do from a personal standpoint?
The single greatest thing is scheduling time, blocking time. As an example, this has been on the schedule for weeks. It just sits there. Yeah. I run Google Calendar, and everyone on my staff has access to my calendar. So like now, everyone in my universe knows exactly where I am and what I'm doing. So I'm not going to be disturbed other than the phone's totally disturbed. No one's going to come bother me doing what I'm doing. So me, it's all about time block, time management, and being disciplined with that time, and very, very willing to tell people no.
I like that. It's important too, because you mentioned that you've never missed a deliverable. And I think especially from a title perspective or an inspection perspective, if you want to have longevity in this game, deliver docs when you say you're going to do it, because everything is so time sensitive.
Right. And some of that goes back to the individual investor or the person requesting that timeline or that document. You can't have a crisis at the last minute. If you've told the inspector, you've told the title company, you've told the lender, somebody's got to be driving that bus and scheduling those things so they come in the right sequence. Because as we all know, when things get out of sequence, that's a domino that boogers up the whole mess. So scheduling and time management, I think, is critical.
And that's why you need a coach to walk you through your first deal like I had, because things are moving at you fast. You can still call someone and say, hey, what I need, but you need to know all the steps to work this thing. How long is due diligence? When should I talk to the broker about getting an inspector? When should I talk to a banker about about getting the loan? All those things move so fast on your first deal that if you have somebody helping you out or even able to get on the phone whenever you need it, it's really crucial and it's really important. And, like I said,
there's just going to be things you don't know. And there's nothing wrong with that.
Mm-hmm.
You're shortening the learning curve. That's great.
Mm-hmm. I agree.
Coaching is critical. And, you look at the most successful people in every area. Doesn't matter whether it's sports or fitness or business or whatever it is. Everybody's got coaches. I'm hesitant to bring this guy up, but you get a guy like Tom Brady, probably has 10 or 12 coaches. He's got a guy for nutrition, a guy for fitness, a guy for flexibility. He's got coaches what to do with his money. He's got the best and brightest minds around him. And that scales down to the rest of us also. I tell people all the time, if you can't afford a great coach in your endeavor, you really can't afford to be in it.
Mm-hmm. Yeah, I agree.
Any book recommendations? It can be general business related or inspection. Oh, there we go. We know those guys.
You know those guys?
Yeah.
I'm actually on their staff. I'm a one thing certified coach. I've also been on their bold business coaching team. A big fan of Gary Keller as well as Jay. But this single book, depending on which list you read, by many is considered the greatest business book ever written. And more than anything, it's about managing yourself. And Gary talks about you don't manage time. You can stare at the clock all you want.
Tom Brady effect.
Exactly. So I'm a giant fan. I live this. I love this and recommend it highly.
For the folks that aren't on YouTube, we're talking about the one thing because sometimes we forget about our iTunes folks.
Yeah. The one thing, Gary Keller, Jay Papasan.
So Jake, Wally's touched on a lot of times about clarity. And when you read the book and you're a life coach and you're doing coaching with a life coach, it's all about clarity, what's important to you. So that book, The One Thing, will give you clarity on what's the most important thing you need to work on. And from there, all your other, I guess, areas will emanate from. So if the most important thing for you is to get a deal, I need to get a deal. That's the most important thing. Okay, so now you know all of your functions to do that. Focus on the market, start calling brokers, start doing property tours, and that will eventually lead to that one thing that you're looking for. So I totally agree. I love that book.
Yep. Gary says clarity is power.
Mm-hmm.
Yeah, no, Jay was a really cool guy. It definitely was an eye-opener when we had him on the show. Wally, what's the best way for listeners to get a hold of you and take the next step if they're in need of inspection services?
The simplest thing to do is the website, which is monumentcommercial.com, or via the telephone. The area code is 904-660-2915. And the staff will schedule time for us if it's lengthy. If not, we'll get right on it.
So G-Dad, take us home. Summarize this. What do we need to do?
Well, first, a couple things. First thing I want to let everyone know, if you've made it this far in the podcast, Mr. Stenziano is going to give you 10% off coming to the live event this October.
Oh, man.
Links down below. Type in the word podcast. That's the coupon code. At the live event, you're going to be listening to Buy Right, Manage Right, and Finance Right, and inspection and horror stories from students. So I think you need to be there. The second thing is I just want to thank everyone for listening to the show. If you guys want to leave a review or subscribe to the show, that would be awesome. We'd love to have that. And I think just to summarize the entire process, for me, I learned the two most important words in investing, honestly, Jake, were due diligence. And I didn't know what that meant in the beginning. And not that I was cheap or not cheap. I just didn't know the process. I didn't have a coach to coach me on. And then when I learned, and I lost $500,000 in the deal 10 years ago, I learned that word really quick. And it's important to walk through the entire deal, trust but verify. We had a student right now that is going through a deal, and now there's an eviction that popped up. And he's past his due diligence period, and he didn't verify that. He didn't know to ask that question. I said, that's a great learning question. You're going to know that for the next time. And the broker's like, oh, yeah, by the way. What do you mean? Oh, yeah, by the way, the broker knew that. And
there's a lot of by the ways.
And it's
part
frustrating. It's frustrating. The eviction's going through. He might lose a month or two of revenue. It's not a deal killer. It's only an 8 unit. But at the same time, you have to trust everything, but you have to verify everything. And the deeper you can get into a deal, the less risk. So you're always, as an investor, trying to limit your downside risk. So what you're trying to do is trying to find out as much as possible. And from spending $5,000 or $6,000 or $10,000 on an inspection, you may be able to get $30,000 or $40,000 off the price if you find stuff. So don't be afraid to spend money on the front end, because it will help you out on the back end, and will also help you create a budget. So when you see these problems, oh, wow, I need to allocate X amount of money to the driveways. I need to, put a certain amount of money for all the hot water heaters or for the AC units. All that work is being done on the front end, so you don't have any surprises. So when you're raising money from investors, you know exactly how much to raise. So I think it's important. Due diligence is vital. Go online, look for inspectors. The two best ways that Jake, I think, like Wally said, is get a real estate broker. They give you some kind of recommendations, give a lender some kind of recommendations, and don't cheap out. Anything else?
Yeah, I would have to guess, and Wally, you don't need to comment on this, but I would have to guess that more times than not, Wally ends up paying for himself. Dollars and cents at the end of the day. I bet a lot of that money comes back.
Yeah. In the history of negotiation, there's never been a swing in price that was less than the due diligence cost.
Guys, I really appreciate it. Wally, thank you so much for your time. I really learned a lot today.
Thanks a lot, Wally.
Take care, guys.
Take care.